Back. You're watching The Money Show on ET now. Well, it's time for our Meet Your Fund Manager segment, and I suppose it makes sense that given the fact that we are just 2 months away from, March 2021, yes, it's already that time of the year where we need to get into tax planning mode, lest we wait till the very last minute. And one popular mode of tax planning is the ELSS, or Equity Linked Savings Scheme. So we decided to bring on board the fund manager of one of the best performing equity linked savings schemes in the last 1 year, 3 years, 5 years. Aakash Manghani, fund manager of equity with BOI AXA Mutual Fund, joins us now on the show. He also manages the BOI AXA Tax Advantage Fund. So Aakash, thank you so much for giving us time today, on ET now. So Aakash, to start with, great performance by the fund. Your investors, I'm sure, are really happy with the 30% return that they're sitting on. Add to that, of course, the tax benefit as well that you get, right, when you invest in the fund. So tell us a bit about the fund. Where does it invest? What's your investment strategy behind this?
Sure. Good evening, Movina, and to your viewers. Thanks for having me on the show, and thanks for the kind words. The Tax Advantage Fund at BOI AXA has actually a 13-year track record. In this Feb, we'll be completing 13 years of running this fund. It has an AUM of roughly 400 odd crores. As you rightly mentioned, over 1 year, 3 year, 5 year periods, it's handsomely outperformed its benchmark indices, and it's in the top quartile of its benchmark. What's more interesting is that right since inception, the fund has delivered roughly 18% CAGR, right? That's basically if somebody invested 10,000 rupees in Feb 2009, the fund is up approximately 7.1 times. So that's a fairly handsome record for or return that any investor could get out of equity investing. During the same time frame, the BSE 500, the benchmark, has given about 17% CAGR, so we've beaten the benchmark handsomely. I'll just quickly tell you about what the fund is invested in right now and what's been our investment style and what's helped us to do so well over the last couple of years. So essentially, this is a multi-cap fund. It has investments across large, mid, and small cap. Majority of the corpus is deployed in the large cap category. So roughly 50 to 55% of the fund AUM is deployed in large caps. About 30 to 35% is deployed across mid caps, and the balance is small caps. So that's where the fund is deployed. A very unique aspect of this particular performance that we've managed to achieve over the last couple of years is that although the returns have been, much above our benchmark and beating the index, this has come at phenomenal risk-adjusted return. So over the last calendar year, we did this calculation for CY20. BOI AXA Tax Advantage Fund had the best risk-adjusted return, and over the last 3 years, it's in the top quartile of its risk-adjusted return performance. So that means we are giving investors a handsome rate of return with minimal volatility possible. So that's what we've done over the last 1 year, 3 years. Where we are deployed in terms of sectoral allocation has been key to getting this performance over the last year or two. So over the last year and specifically now, we've got 3 key overweight sectors where we deployed the corpus over the last year or so. Primarily being pharma, chemicals, and technology. During the later part of the discussion, I'll talk to you about what we see in each of these sectors and why we deployed a significant amount of corpus in these sectors. But these 3 overweight sectors constitute roughly 36 to 38% of the allocation in the fund. And financials is more or less an underweight or an equal weight for us. Autos have been an overweight for us. So this is where a large part of the corpus has been deployed. Regarding your second question, what's been the investment strategy and or the style that we adopted over the last couple of years? So, essentially, there are different styles of investing and different ways of getting the same return. We've had a very simplistic approach to investing, which is we identify high growth businesses run by extremely smart promoters, which are deploying their capital at meaningfully higher rates of return. now meaningfully high rates of return being they should have a decent amount of spread between their return on capital and the cost of capital. Because over the long term, you end up creating wealth for yourself and your investors only if you are able to get that spread. And the higher the spread, the better it is for the business. So, if I were to delve deep into the investment strategy, how are we going about finding our ideas, right? This is one thing, looking at high growth businesses, but the business needs to have a very high runway for growth, right? The higher the runway for growth, the better it is, the better the compounding of the business can be. So that's one thing. The other thing is that one needs to look at the business quality and the moat. Very important is whether the business is already a moated business or is in the moat creation process. A lot of wealth, disproportionate amount of wealth is created when you can identify a business which is in the moat creation process. I mean, there's no point buying the largest FMCG company, the largest paints company, you can buy that, but will that give you disproportionate return? You'd rather, allocate your capital where you can get a business which is in the process of creating a moat, and 5 years, 10 years, 15 years down the line, you get to see financial metrics which are at par with the best in the category. So that's where we find disproportionate alpha, and we look at such businesses. The most important factor is the management quality, the pedigree of management, the integrity, the execution track record. So, we use a mixture of quantitative and qualitative filters to figure out where we should go about hunting for pockets of deployment, right? And we realized over time that, and we've read this time and again, that management is the most important thing, right? Over time, we've perfected, or we're not perfected it, but we're trying to get better at identifying which are the managements to back, which are the managements which will continue to surprise, get into new growth avenues, figure out ways to navigate a crisis smartly, figure out to allocate their capital in the smartest and most efficient possible manner. So these are the three things we looked at,
Fair. Right. Okay, I think, Aakash, you've given me a very in-depth answer on many of my questions, so thanks for that. Now, in the last few months, however, we have seen outflows from ELSS schemes. I don't have the January data, it's not yet updated. But yeah, usually we start seeing net inflows in December. So why do you think this is continuing? I mean, is it on account of this whole profit booking mode that most investors seem to have gotten into?
So, it's not only the ELS category, but if you look at the data for the last 6 odd months, the entire mutual fund category has been having some sort of outflows. And that could be partly because, people are seeing handsome returns after a period of 3 to 4 years. People who are invested in 2016, 17, 18 are redeeming their money in tax category, probably locked in that 3 years and that's getting over. So they're seeing their, money back, so sort of say, and they're looking at this as an opportunity to get out probably. I don't know whether that's the smartest thing to do as of now, because we are quite positive on equities as an asset class, and we don't see material risk to the way we are heading right now as an economy, as the equity market is shaping up. So I think sooner than later, investors should be back. Majority of the inflows anyways for the ESS category comes in the months of Jan, Feb, March. If you look at the last 1 or 2 years of data, roughly 35 to 40% of the inflows comes in Jan, Feb, March. So we're hoping that, for the industry, the net negative number that has been there for the last few months turns into a positive number. But interestingly, I would like to point out that our fund all along for FY21, each month has been a positive net inflow for the ESS fund. And that's been because, as you mentioned in the opening remarks, our returns have been quite good. So I guess at some level, investors have taken a note of that, recognize that our processes are sound. We are backing really good companies which have delivered handsome returns, and probably at some level, they're having faith in our ability to deliver over the next couple of years as well. So the inflows for us, for our fund, has actually gathered pace, and month on month for the last 3 months, it's a very, very handsome trajectory that we're witnessing.
All right. Well, Aakash, thank you so much then for joining us today on ET Now, and just giving all of our viewers a gist of or a sneak peek into BOI AXA Tax Advantage Fund, and ELSS scheme that could be used by our viewers, as they get into tax planning mode for FY21. Remember, folks, it's highly unlikely that FM Sitharaman will grant you a 3-month extension for your tax planning as she did for last year. So don't leave it to the last minute. And we'll do one thing. We'll take a very short break right here on the show. Don't go anywhere.